Yeah, good evening, guys. This is Ken at Tortoise Capital Foundation's check-in for November 9th, 2023. So, my my good friend Jim Carroll sent me this screenshot of page 20 in the book, and this is why Jim Carroll succeeds. He's an analyst by training. He's a pro money manager. You have to have a minimum of 2 million in the account for him to take your call because he's got to guard his time. So 2 million is the minimum account size that he will consider managing. And I've known him for about 20 years. He was one of the first 10 subscribers that I ever had from back in the days. He says, "Yeah, so you did this on purpose." And I said, "Yes, you are correct." And here's what he said. So the page was about the perfectionist trap. And this is just, I'm going to probably just read this because I don't know if I could say it better than I wrote it. But I found it difficult to begin the project of writing the book. I knew I had to write the book because I knew after Van's passing that to maintain the organizational momentum of this community, that we needed a book that talked about the brand and acts as an anchor. And from that, there's power takeoff shafts. A PTO shaft is, well, first of all, that's the most likely way that you're going to get killed on a farm. Is that a piece of your loose clothing is going to get tangled up in the power takeoff shaft on your tractor, and it's going to pull you into the spinning blades, and it's going to rip your arm off and you're going to bleed to death. So a power takeoff shaft is simply a drive shaft that's connected to the engine on the tractor, and it spins, and then you can put implements on that and it'll drive different tools. But so it has these little catch blades that you can hook into different farm tools. But if that grabs your clothing, it'll kill you. So you got to be careful with that. Books are like that. So I had about 35 years of experience that I wanted to somehow get into that book, and I wanted to honor Van and then all of the other uh, contributors to my state of mind, to my brain housing group, to my cognitive background. So that there was a lot of things going on with that, and I was having a hard time getting going, and it was the perfectionist trap. The only way I got through is I had to say, look, this is just going to be volume one. What was making it hard I wanted to get it right because I am motivated by a sense of duty to others and to do no harm. So I wanted to be sure that I was getting it right. Trading is a challenging profession. Drafting a book about that is every bit as challenging, and it was filling me with fear about getting it wrong. I wanted the book to be the best that I could produce with the help of others, which gets you right into the perfectionist trap, which is kryptonite to traders when they try to be perfect on every trade and with every decision. It's that search for certainty and to be error free. Van would talk a lot about the cost of errors. And you could incorrectly assume that that means you're trying to be error free. What I think it means is, like in manufacturing, we're trying to control our errors so that we can afford the cost while we're continuing to try to get better. But if your performance level is here and you want to get to there, but the cost of that action A that gets you from stage one to stage two, if the cost of that is greater than the value that you gain, then you shouldn't do that. You should be operating at the affordable level of quality and keep working until you find cheaper ways or better ways to increase value at an affordable cost. That's the value proposition. And that's different than being error free, especially in an open, chaotic system like the markets and an open, adaptive system like ourselves. Error free is, I believe, an incorrect goal. But you could see how that could come about. I believe that the search for error free leads you to madness. Now, I've known that with my head for 25 years, and I've always found ways to be good without being perfect. And I have learned in the market to sacrifice being perfect in order to be good enough all the time. And yet, when I stepped out of the trading environment and into the book writing process, I ran right smack into the perfectionist bias once more. So even though I feel like I've solved that problem in trading systems, when I got into a new environment in book writing, there I was back in school, a 12-year-old child worried about missing questions on the test. So what helped me to get through that mental block in writing the book was the same thing I do in trading, and that was step back, breathe deeply, think about how I overcame perfectionism in trading, and then applying it to writing. So I say that in order to say, with that in mind, I offer you these ideas and insights about the dangerous perfectionist trap. And I'm thankful to the patience of my writing partners who put up with my lack of progress. And in that spirit of gratitude and forgiveness, which is central to our values and our community of practice, I'm grateful to their patience and I ask your forgiveness for any errors in this book, which are solely my responsibility and not those of my co-authors. So when I first wrote that, the second patience was spelled correctly, and then I thought it would be funny and somehow fitting to spell it as patience, because this does not get picked up by spell check and it doesn't get picked up by grammar checker because it's a correctly spelled word and it doesn't know how to make sense of that. So I had to change it back to the incorrect spelling the second time in order to just plant that as a little Easter egg. It got through Grammarly. It got through the first round of editors. It did not get past Phil Wu. And then I had to explain to him why I wanted to spell it that way, because I wanted to see what might happen, and I wanted it in there as a deliberate. And Jim Carroll sees that. Jim Carroll, like I said, is one of my first 10 subscribers from back in the 90s, and he manages money professionally, and he's come to every one of our research weekends and has been developing systems on the management of volatility, and and I've helped him with some of those shorter term systems. But he saw that and he sent me a note and says, "You did this on purpose." So that's how perceptive and aware he is. And I sent a note back and said, "You are correct, sir," because somehow this completes the circle, a theoretical warning about the perfectionist trap, and then an actual living example of it in action as I am asking people to forgive any errors they find in this book. So as you go through trying to learn this loosely organized collection of material, that's going to be on your mind because you're trying to get it right the first time and get it just exactly right. And you're going to practice trading and post charts bravely to demonstrate your learning and progress. And inevitably, you will feel that you didn't get it right, or maybe you didn't understand my poorly worded explanation or whatever. That's going to be a really important part of surviving the perfectionist trap, allows you to endure, and you got to replace the desire for perfection with robust survival. You don't have to be right, you just can't stay wrong too long. And so, learning to cope with that and learning how to don't let the best be the enemy of the good or good enough. It's like the two guys in the woods with they see a bear coming, and the guy stops to put his tennis shoes on. The guy says, "You can't outrun a bear." He says, "I don't have to. I just got to outrun you." So we just got to be good enough to survive and thrive. So I would just give you that, cautionary tale as you go through the hundreds of videos that we're working on. It would help the team uh, if when you get your book, or if you buy the book, to spend a minute and give us a 5-star, even if you don't believe it. We can both live with that white lie, but it helps the team. Um, what I wanted to do was, I don't recall seeing specific questions from you guys, and if you did, I just missed them, and I will answer them on Sunday. But today was just a really good day of trading while I was preparing for a couple uh, self development sessions. So what I was doing was just to prepare for those, was I was just trading because I enjoy trading and I find it relaxing. And that little bit of disinterested attention, I focused on other things, but just trading in and around that was very relaxing, and I really traded well, and was rewarded with price action that made it look easy. And so and it highlighted a couple really important facts that I wanted to just reinforce. And one of them is this idea that if you have something like the average and then plus or minus one, that the abnormal ranges are these extremes. And it's from the abnormal ranges that big results come from. Whether this is volatility and this is abnormally quiet and that's abnormally volatile, the things that are so quiet that it's abnormally quiet often surprise you with big moves in either direction. Compared to how tight and small the doji is, you end up getting large moves. So abnormally quiet is a big deal. You want to find those moments. And then abnormally volatile, it's easy to see because it's already in play, like the way AI has been all week. And I'm thinking about how I've been describing the AI trades this week, and I don't like my tone of voice in there because sometimes I feel like people are not listening or taking advantage of the things I'm pointing out. And there's nothing more dissatisfying than giving a gift, except for giving a gift that people aren't using. That really, if you're not a natural gift giver, that's even harder to take. So I've been a little snippy about that. But AI has been in play all week, and it's been rewarding the intraday trade quite nicely. In the same way that MSOS had been very large, it was like averaging 9.5% intraday volatility. The last 4 or 5 days, it hasn't done that. And so it has become quieter and choppier. And so it's not as good on that hybrid swing trading as it once was. Part of that is, I think, a bunch of people just got disheartened, and it's out of the compound critical state, and it's just back to normal volatility, which is somewhere around 6% right now. But AI is going through some temporary phase. I think it's temporary until it calms down, it'll be continuous. But I think it's temporary, but it's going through these extraordinary large and directional moves. I mean, it's one thing to have a large range, it's another thing if it goes like this, that's hard to take. But if it started here and then went there, that feels easy because you got a directional move and large range. That's ideal. So right now, AI is inside that kind of a mood. That's the current flavor. And AI was a trader today. ETHE was a trader. Disney was a trader. And now the idea of market, sector, and company is really key. So if the market's worth about 50% of the return and the sector is worth about 25% of the return, the company itself accounts for about 25% of its own performance. But it inherits the movement from the sector that it's in and from the market condition. And the market, especially right now, is at the tail end of a 10-day move that is of historically strong proportions. Like if we took price 10 days ago and then yesterday, and if price was here 10 days ago and is there today, we could say, well, that is the slope, call it alpha, that slope of angle alpha that talks about how good the gains were. You could take the actual dollars and divide it by price, and you would get some kind of gain percentage. But that could also be represented by that slope. Well, if some other thing over that same period, and if you normalize the percent gain, you said it was like that, you could say, well, all other things being equal, I would prefer tomorrow to trade B rather than A because there's some historical outperformance. And if these things just continue on, it's easier to trade B than A. Well, conversely, if you just looked at the life cycle of A, old target A, and you went back 210 days to day minus 181, that's a 30-day window. And if you said over that 30-day period, the angle was this, or the percent gain was that, and then drop a day and add a day, you could quickly get 180 days data of the 30-day performance. And then you could rank that from max to min and average, and then plus or minus one standard deviation, and you could call that normal. And then you would have some kind of 180-day sample for reference to say, this is the threshold of abnormally good performance. That if it gets above average plus one standard deviation, that we can say this thing is on a tear. It is abnormally strong over these last 30 days. And conversely, if it's below that threshold down to the minimum level of performance, you could say this thing is, below minus one z-score. This thing is abnormally bad. Well, you can now set up some kind of time series that has the average and then you could set up a plus one standard deviation. A plus one standard deviation and a minus one standard deviation. And you could just say, look, As long as the 30-day slope is inside that boundary, this thing is just behaving as per normal. You could almost look at that like a tachometer and say, hey, if this thing is like this or it's like that, it's just in the range of normal, nothing unusual. But if it dips down into here, we have reasons to believe that something special is going on that's causing this thing to fail at a higher than normal rate. And conversely, if it was above this, it's gaining. So other things being equal, you can study where we are in this. If my gauge looks something like this, if that's the zero line, I could say, hey, that's great, that's bad, and now I have a tachometer, and I can, or a slopeometer, I could rapidly determine where A is within its life cycle of statistical performance, and then for some, at any time period, I could compare items A through Z and see which ones are outperforming themselves or outperforming the peer group. You'd like something that was outperforming itself, its normal, and outperforming the peer group. Then you have something that's double plus good. Well, right now, the market, its 10-day performance has been extraordinary. And now the price pattern that it has looks like this. Well, I'll just call that up on the screen right now. It looks like this. You know, you got the slope of the 10 period right here. It went into it left winter and got into the spring and then back to the winter. And remember what we said last week, winter, spring, winter was an instant short. Instant short. I should have also said, and here's what I mean. As soon as that went into winter and it went below this bar, as soon as it goes into winter and price goes below the low of that day, this is an instantaneous short. And you got a 3-day move from 422 down to 409, which is minus 12 bucks on 400. That's a 3% move in 3 days. That's more than one ATR percent, one weekly ATR percentage in a 3-day directional move. And here was the indication that that was occurring. And we noticed that we were already below the collapsing dragon from over here. So as soon as it goes below here, I now have a collapsing dragon to the downside. And I have a winter, spring, winter reason to get short. And it broke yesterday's low. And it's coming into the danger zone, as we've seen before, and approaching the 30-day low. Well, heck, it was actually making new 30-day lows on each one of those days and selling off. So when I think of the market sector company, I get 50% of the answer correct. If I had 20 questions about how to trade symbols, I get half correct for all of them simply by getting the market call correct. So while this is failing, if I have a stack of symbols and I rank them in terms of performance from best to worst, and the market is failing, well, first of all, I could just trade the market short, but I might also want to look at the things that were failing faster than the market and reason that those are the things that are contributing to the abnormal sell-off in the market. So that's one way to play that. When that fails to fail further, we now have an extreme move, a 30-day low. We have a PSAR flip right here. But we also have a reversal of the slope of the RL10. It was going down, and now it's going up. So as long as it stays north of that line, every upward move is additional information that it's working. Now, when this started happening and we see 1, 2, 3 entry right here at the skin of the dragon, think about what the skin of the dragon means as a piece of information. We had an extraordinarily strong adverse move that terminated in a sharp reversal, and now we have a 1, 2, 3 entry. We have a 1, 2, 3 exit. Hey, if I got short anywhere in here, the latest that I can afford to stay short is at the skin of the dragon, because if I do this right and I get short at the PSAR flip, and that is my risk box, and I have 2 units of reward to the bottom, while I'm enjoying this, when price reverses to the skin of the dragon, I got to get out in order to capture that move, which is about 1.5R. Well, if this is a clear sign that the downward move might just be over, that also says, hey, it may be that the upside move is okay. This actually represents a turning point. That's about the earliest I can afford to get in and still preserve 2 units of reward on a reversal to the top of the channel, which is marked off by the peak of the RL10, which is marked off by the PSAR flip, because anything north of that's going to be an emerging dragon, and anything south of this is going to be a collapsing dragon, which means that my working channel is this one. And that's about a 10-day channel of opportunity in here. So if I can be getting long about here, if I can exit the short here, I now have 2/3 of the channel ahead of me, and I'm giving back one third of the channel to ensure that I've given it a chance to continue to fail. So that 1/3, 2/3 approach. Well, when this happens, we didn't know that we were going to get 3 days that look like this. A gap up, which stayed at the bottom of the daily bar. That's in the bottom 10% of the bar. And that happens two days out of 5. Only 40% of the time does the open fall within the upper 10% or bottom 10% of the daily range. Here's one where it did. Now look at this. Not only did that happen on the open, it also happened on the close. That was an extraordinary day of large range and pure direction. It opened near the bottom, it had a large day, and it closed near the top. Well, that's unusual behavior in a major modern appliance, the Ghostbusters. And then the next day there was a big gap, and it did the same thing. Opened in the bottom 1% of the range, had a large range day, and closed damn near the high of the day. That is the opposite of a doji. A doji is a day where you have a small range and the open and close are very close together, and they're in the middle approximately of the range. If you go all the way to the other end of the extreme, what you have is a large range day that looks like that, where the size of the move is large and the open and close form the endpoints of the daily range. That is a large directional day, and this is the opposite of that. It is a small undirectional day. We like both of those things. Why? Because they are at the extreme. When all this normal behavior of size of the range and the degree of directionality, there's no new information in here. It's just the market monkeying around. But when you get these abnormal conditions, you're getting information about an abnormal state in the market, which means that all of the things that are correlated to the market may also be inheriting some of that abnormality, which means you got to be prepared for unusual behavior. Guess what else we saw? Then the third day, there was another large gap up and a large range up, but then it also reversed intraday and came back and closed in the bottom third. Now, that kind of a day is different than these two intermediate days, which left the market behind, had this amazing run up, and then gave back. So now we can say, oh, that was Monday clearing the deck. And we say, now, is that going to reverse and just give us a standard downward slamming, grinding, failing market? Or was this going to reverse and then break out above the 10 and 30-day high and off to glory? No, it actually did something else. Also very interesting. Higher lows, higher closes, and on these 3 days, higher highs, which came back and tested the previous 30-day high and which closed above the RL10, which means yesterday was the beginning of an emerging dragon, which now leads us to this day. From here, we could say we have a compound critical state at the top end of an extraordinarily steep 10-day move, which had intermediate days of enormous range, but is now coming into the station into almost doji-like conditions. And it's either going to fall off a cliff or it's going to rise to the moon. And if I can put a tight little wrist box around that doji, especially when it opens, I might be able to actually trade that. Because we've gone away from these large range directional days all the way to the other end of the spectrum, which is a tightly compressed doji kind of day at the end of a 10-day move. And because that's the condition of SPY, then every single sector that's a member of SPY is inheriting some of that criticality, some of that radioactivity. And then a sector like XLK, which had been leading the market north during this 10-day extraordinary run, maybe that's going to keep going while the market tails off. Or maybe it's going to sharply reverse and then cause the market to sharply reverse because it's in a leadership position. I don't know. If it starts just going sideways here, is finance going to take over and become great? Is energy, which has been lagging, suddenly going to become cyclic and move into the leadership role? Well, I don't know. But now, instead of just understanding the market, I can now think of the market, and I can think of those 9 large sector components and see where they are in their cyclic nature. Are they at the bottom in the winter and starting to go spring? Or did they just finish the spring and go into summer? So with only 10 pieces of analysis, 1 for the market and 9 for the 9 sector spiders, with just 10 questions answered, I have now accounted for about 75% of all the variation that's going to happen to the individual stocks. Check or hold. The first piece of analysis, the market, just 1 piece of analysis gave me the first 50%. The next 9 pieces of analysis gave me another 25%. And that's for the US market. If I just look at 5 to 6 indexes in the globals, I can get to that same level of information about the entire global market. So I can look at the S&P and the 9 sector spiders and understand half of the market, which is the US, and I can study 5 or 6 indexes and understand the global, and now I've accounted for about 95% of the entire market. The only thing I don't have are some of the small caps and some of the emerging markets. But I can study those as special cases because they are so small, they can't really move those big markets. What you can get is by specializing in them, you can get some short term abnormal gains, sure, in the same way that IYR real estate has been doing that because it's its own tiny little separate sector. Well, I say all that simply to say that when we have gone through a process that goes through market classification and strategy and gone down into sectors and into targets, and then we look at patterns and continuity and the specific setups, we end up with some list, some narrow list of individual companies that meet our criteria, and then we set that trade frame up. And I don't know that I've been emphasizing enough why you still have to consider the movement of markets and sectors while you're considering the movement of the companies. Like, this isn't just for planning. When those markets and sectors are moving, you need to see how they're moving because that's going to give information to individual companies. For example, if I had a company of interest over here, I want to know what his sector is doing. I want to know what the market's. Imagine the market was a big, strong, powerful upward move, and the sector was a big, strong, powerful upward move that was better than the market. Well, that's telling me the market is leading the market, or the sector is leading the market north. So if I had two or three companies in that sector and the top one of them was double plus good, that's how I find the mover, is because the market is contributing, the sector is contributing, his own excellent performance is contributing to dramatic outperformance. So you might see something like a Microsoft turn 6%, while tech was up 3%, while the market was up 1.5%. And that is an easier move to trade because it is so dramatically large and directional. So, a big idea is the market sector company. And the idea of critical states and turning points. And then interpreting the context of price action. And then today, what did it do? It gapped up, and instead of following through large, and instead of just continuing this tight little range compression for one more day, it actually voted down in a big way. And it closed at the black line right near the low of the day, which made a 4-day low and is actually threatening the 5-day low. And then if that fails tomorrow, that gap has no support whatsoever, and that means if there's any weakness tomorrow, it's instantly back into this range. And this whole thing, which has come into the 12 o'clock position, even though that's the summer, remember it's summer because it inherited some of this, it's already ready to fail large. That's the RL10. The RL30 is still sloping up. It would take 3 or 4 days of the RL10 to fail to get an RLXD and to cause the 30 to start rolling over. So we are in a temporary moment of tactical significance and maximum uncertainty. And tomorrow on a Friday, there's going to be a lot of guys that say, you know what? I was smart and I got my entries in here and I gave it some room today to try to get going. But today was day one of a failure. I am not going to give back this middle ground. I'm looking to preserve my positions that I earned money all the way up. So there's a very good reason to believe that there's a lot of buying or selling decisions that will happen between 430 and 433 in that little 1% range. If that breaks, the skin of the dragon, we're out. So in my view, the proper place to have the stop is right at the skin of the dragon. Why? Because you had an extraordinary move, and you want to respect that. And the RL10 is signaling uncertainty. It's in a state of maximum uncertainty, just like it was here, just like it was here, just like it was in this temporary pause. And when that resolved to the downside, it dropped off for 3 days in a row. And then it paused. And what was it going to do? Go down large or up large? If it was going to go down large, we said that thing could go to 390, but it didn't. It gave us leg one back to parity, and then leg two, catching a lot of people by surprise with all those large range directional days with big gaps. Well, you could get lulled into a false sense of security and say, well, that's what it's just going to keep doing forever. No, it did something else. So we are developing a feel for the ebb and flow, for the tidal forces pushing this thing around. This is an increase of volatility. Look at the size of those expanding waves. So wherever it goes from here, I'm inclined to believe that that is the size of the next move. If it fails, the first thing it's going to do is come back to here and test. And if that fails, it comes to here and it tests. And if it gets to here, it could go to here on a third leg, or it could reverse just like it did last time. All of those moves are tradable. And on the 30-minute chart, I can get standalone intraday trades that are legit on the 30-minute bars as you see me. And then I can pick the ones that are moving and get on the 3-minute bar and really exploit that. That's what I want to say about where we are right frickin' now on Friday. Friday is a special day. Why? Because we're a world at war. And there's a lot of news about the Treasury and politics and leadership and craziness going on. And guys want to preserve this. So we could see some tactical selling that leads to momentum selling, that leads to a runaway give back, and it goes all the way back to 424 tomorrow. That would be a double range stat day. Absolutely possible. Oh, it could also find support, and guys could say, you know what? It's actually had 1, 2, 3, 4 days to fail below this key support level, and it hasn't. I'm going to take that as signs of resiliency in the market, that there was money coming in and buying these to prevent the backslide. There's 4 pieces of evidence that said there was enough buyers to keep it propped up. And if those guys want to come in and signal strength, you could also see this as a buy on dip opportunity, and guys make money inside here on leg 1, and then leg 2 it breaks up and goes all the way to 445. Could it get there? Sure it could. It could gap that far, so it could gap to here, and then if you just take the size of that move, it could get to 445 tomorrow. Both of those are about equally likely. They're possible enough that you've got to be prepared for that move. If either one of those moves happens, whether it goes from a gap here and goes here or there, it starts off with the open for me tomorrow, and I put a little minimum manageable risk box on that rascal, and then I'm just going to trade it in the usual way. If it goes up, I'm going to buy it with my little risk box, and I'm going to try to get my stop to no lose plus dinner for 2, and then just respect the move, and then make a decision about how much, if any, I'm going to hold over the weekend. And my answer for tomorrow is 0. I'm not going to hold any positions over the weekend unless I have 10R in hand from the intraday trade in that sequence. That's my decision already, so I don't even have to think about that for tomorrow. But if it also gaps up or down and then breaks south, I'm going to be short on a collapsing dragon kind of a play. And I'm going to do the same thing. I'm going to get my risk out and work it all the way down. And I'm going to offload all of those intraday positions and only hold things over the weekend that have a minimum of 10R in hand from the intraday trade. Check or hold. Now, how am I going to find those things tomorrow? Well, what I'm going to do is I'm going to have my stack of 30 standard symbols, and then whichever ones gap the most, it's going to be either a plus percentage right from the open because it gapped higher than today's close. So it's going to go right to the top of the stack, or it's going to be a massive downward gap and it's going to go to the minus percentage. And out of those bottom three and top three, I'm going to pick the things that I start trading right from the open on 3-minute bars by bracketing the opening with a MMRB and then taking the first 2 or 3 that actually break out and then try to turn some of those into the trade of the day. That's what I'm going to do tomorrow. Why am I going to do that tomorrow? For all the special reasons that I said, and because that's what I do every day. So in one hand, there's absolutely nothing different that I'm going to do tomorrow that I don't always do. But there's a special case tomorrow because the market itself is in a compound critical state on a Friday while it's a nation at war. And there's some continuity trades that I'm going to now show you from today that look like they could be very interesting tomorrow. So they're going to automatically be at the top of my list, ready to go. And even if they're not a big gap, what if they have zero gap? Then I'm going to treat the open the same way. I'm going to put the bracket on them because they are inheriting large moves from the last 3 days of trading. And so wherever it opens, I'm simply going to bracket it and I'm going to prioritize those things trading, even if they are not large gappers. So the 3 symbols I'm about to show you, plus anything that gaps large, is my first best trade for tomorrow. Check or hold. So here's Tesla. It's in play. It's the most important stock in the world. It closed here. Big gap there. There's the OR3. Second bar, that's an OR3 entry. Would you agree? And your head should be nodding up and down. Yes, coach, there is no clearer, perfecter example than that one of something that is in play. That's everything. And then within 2 bars, it's already more than an R in hand. Couldn't you just go like this? And now you've locked in some little wedge. You're not going to lose money. The price is here and your stop is right there. You're not going to lose money on that trade. What would we call that? We could call that a collapsing dragon or a kata 2. We could call that a 3R battle drill to add a second position. The PSAR is still tracking. The dragon is sloping downward. So I get 3R in hand and now 2 positions and prices right here. And my second entry is here. The second entry is already in the market or in the money. I'm not going to lose money on the second position either. So that's around 5 or 6R in hand. and it was the one of the worst performers that morning. And then it didn't fail further. You know how I know that it was losing steam? Because the look at the divergence of the RL10 and the RL30. They started off in the same location, and then as this failed, you got this divergence of the RL10 pulling away from the RL30, and then it converged to here. So this is a test. That is a test right there. From your entry right here, this is how much money that I have in hand. It's fallen that far, and this is a test. So I'm not going to lose money on that one. But what I'm really interested in is this going to be a minor victory, or is this thing ready to fail large? It voted down, and here's the collapsing dragon. That's a pocket entry. Instead of waiting for this, I just get it right here because the RL10 rolled over. And now it only came this far. Now notice that in this window, the RL10 is here, and the RL30 never even noticed that little blip. It has now rejoined the RL10. That's leg 2. This is leg 1 where the RL10 pulled away from the 30. This is where it rejoined in leg 2. And now notice what happens. The RL30 is continuing this way and and the RL10 is already sideways. Now you get a divergence. Can't you see the difference in market psychology in leg 3? In leg 3, instead of failing, it went sideways. So if I were to sort of color code that, I'd say, man, this was weak. This was, strong down. This one was a watered down version. And now you can feel the energy coming out of this thing. And you can see that the big dumb river is just doing this because it takes a lot of price action to make this thing never varies much. Like it is the smoothest. And now you got price coming into the PSAR, coming into the dragon. Here's the bottom of the RL30. This is the bottom of the RL10, which is the boundary. That's the boundary to a collapsing dragon. So that is a pretty good exit that locks in all of this, and it keeps the second position in the money, and you get paid nicely from here. Check or hold. So we're trying to appreciate all of the little signposts, all of the little descriptors of market action. And if we're just putting the tote board on it, for the 1 unit of risk, the first position gains 1, 2, 3, 4. The second position gains 1.5. So plus some slippage, that's probably worth 5R. Check or hold. Now, after a 5R move, and the whole market melting down, I'm not interested in this. Why? Because the market was going down huge. And Tesla and the tech sector was also down huge. And Tesla was worse than the sector and worse than the market. That's the least likely thing to go long. If it does, I know how to get in. But all it did was monkey around. And now notice, in this little cluster, we have everything. We have the RL30 has come back. The PSAR has come back. The RL10 is in here. The Dragon is in here. And the Bollinger Band Mean is in here. That's as tightly compressed a little boardroom meeting as you could ever get. And the vote was south. Easy to believe in because we just saw a 5R move that way. So that is a re-entry to the downside with a standard risk box slightly above the PSAR because that's how big the R10 was. Check or hold. Re-entry. To our battle drill, second position. Here was the test, rejected. It barely even made the R10 blip. And as soon as it failed to reverse, second position, that's also a 2R battle drill. And then here, now notice again the R30 is starting to cruise down, but the RL10 is reversing up. That's the divergence that tells you that maybe that run is done. There's leg one, there's leg two, and now here at the test, leg three is voting up. Check or hold. So just exit. And you get 1, 2, 3, 4 on the first one, 2 on the second one. So that one's worth 6. And this one's worth 5. So we're looking at 11R on one symbol that was the clearest, worst mover this morning before lunch. I tried another one and then it just really ran out of gas. You can feel how the urge to go short is over. And I actually tried an SSC and that gave a little bit, but that turned out to be about 13R in Tesla. Check or hold. Ethereum. Here's what the previous day's price action looked like. That's what it looks like when there is only algorithms trading back and forth and nobody is trying to move the price. That's the size of the noise box in our technique of visual box trading. But you don't have to be a proponent of visual box trading to just appreciate what that sort of represents. And you can compare that to the R10 and you would find that it's damn near identical. Which means that if it breaks out from here like it is, you could get 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Perfectly drawn to scale. That could be a range stat. And if that was your little risk box, how much of that could you get? I don't know. Some of it. Oh, but what it did was gap up. And here's an OR. Look what this thing did. Gapped all the way up to here, sold off all the way down to here, and then came all the way back and closed there. Is that what an OR3 looks like? Yes, it does. And here is the next bar that breaks above that, and here's the R10 in ETHE. If this fails, would I go short? If that little red box fails, would I go short? 100% yes. Why? Because this was yesterday's fair value. And there's my 2-to-1 reward to risk ratio. And if this fails, could I add a second position down here? And if so, what's the name of the pattern? Collapsing dragon, correct. So I just buy it, hold my nose. It closes well. Beauty, beauty, beauty. Ah, closed higher, made a new intraday high. Could I decide to do this? Yeah, I could. I certainly could. This is the one that is important right here. I notice that we are at about 2R. The R10 is starting to roll over a little bit. So now it's a question, what are you going to do? Are you going to come back? And I want to preserve some gain, so maybe I need to be here. Or I got to be ready for a 2R battle drill if I want to add, because again, from the low of the day, the range stat move is up here. And so if I can get a second position here, this could be amazing. Check or hold. Easy. Now right here, the first decision that I actually have to make as a sniper, because these are rising lows, and the close was higher than the open every time, and the close was higher than the previous close until we get to this bar. So for the first time in this entire run, and we've got two positions on, we've got higher lows, higher highs. But for the first time, open, high, low, close. I now have, for the first time, intra-bar weakness. So now I got to decide. I got about 10R in hand on two positions. Where am I going to put my stop? This is where the PSAR trail would be, the lower skin of the dragon, the spine of the dragon, the upper skin of the dragon, the 1 bar low. Where do you put your stop, realizing that this locks in about 10R? This one locks in 9, so that's about half of a wrist box maybe. Now I think that one may have locked in, yeah, about 9R. That one locks in 8R. This one, if you exited now, you'd lock in 10R. I would argue you got to be either at 3 or 4. Okay, I want to be at 4 point. Okay, take your pick, but pick one. I think it's one of those. It's either here, here, or here in order to respect the abnormal gain. Make a decision and live with it. And then realize that your manager was probably using the trailing PSAR, and that was fine when price was over here. But you had 1, 2, 3. This was the gift bar. It's already given back half of the gift bar. That's why I don't mind exiting right there and preserving half of the unforeseen gift. That doesn't that feel like the last gasp of buying? And then there was nothing else? No more buying showed up in those 3 minutes. And that could easily become momentum coming to the downside on a very narrowly traded symbol, ETHE, which tracks Ethereum, the crypto coin. If you had the skin of the dragon, which was the next best one, here you are coming into the skin. You also have the R10 actually rolled over. You didn't have any panic selling, but you can start to see, instead of going up, it closed lower and it made a new low. That's a pretty good exit. And that turns out to be 10R. Check or hold. I'm sorry, 11R. Standard work. That's what that thing looked like in the early stages. Same trade, but that's what it looked like this morning. Uh, 30 minutes or an hour into the trade. Not even that. Let's see. 1, 2, 6, 7, 8. 24 minutes into the day. Good problem to have. 3R in hand, second position in, and not going to lose money on that trade. Good position to be in. Disney. Big long visual box. Big gap up. OR3. It opened at the low of the day, if you bought it a MMRB off the bottom, or from the open, I should say, which I think was right here, you end up getting, that's the MMRB entry. That's the OR3 entry. There's that same rollover pattern. Slowly grinding. No real runaway move. And so this rolls over in an orderly way. And I take as soon as that rolls over, no matter where my stop was, I jump it up to the skin of the dragon and out. 4, 1, 2, 3R. That doesn't look like much until you start counting dollars and you say, that's a 3R win. And I'll take that. So that was about 25R this morning, some on the upside, some on the downside, and then this was the kind of day it was. Holy smokes. The last 5 days have been this, and then today it did that and closed here. So you can already see that thing is, it was like an entry to a collapsing dragon. And this is a gap, and this is the next support level at the 5-day low. And if that breaks, then it's down to here and down to here, and then it's the entire, this is that extraordinary 10-day move, which was really, it only took 6 days to get that extraordinary move, and then the last 4 days have been nothing. And then here was the first sign of weakness, and tomorrow is Friday. So if you were ever prepared for a 1-day big move to practice some intraday trading with these techniques, tomorrow is the day to practice that, because everything is set up for that kind of big collapsing move down, or less likely but also possible recovery. Fake 1, go 2. Wherever it ends up tomorrow is going to have policy implications for next week, to see where are they willing to hold. All the guys who bought it down here have a vested interest to close it well tomorrow with targeted purchases of leveraged instruments in the big indexes to communicate strength and buying interest. There's a tactical reason why there could be some buying interest tomorrow by big money who wants to build on this gain and leave the fear behind. Remember, this big thick yellow zone was a support and resistance level from 3 months ago, and it just barely held. They would like for this thing to be the second leg up starting tomorrow. That's my argument for why there could be a big up move. But if they don't want to do that and they want to just preserve the gains tactically, then tomorrow could be a big failure day. It's also possible it just goes sideways, but then we won't win or lose much money at all. So I'm ready for all three of those contingencies tomorrow. Check or hold. That is what planning and preparation looks like. What I just took you through was planning and debriefing the trades and the beginning about that far into prep by laying out the basic strategies and seeing I got to prepare for those three contingencies. And I have a list of targets of about 5 to 10 in mind that I'm really going to concentrate on. And then I got to complete the preparation by drawing their little boxes and preparing the charts for that, which will take me about 30 minutes. And then I'll be ready for the opening. And then I want to try to be at my screen 10 minutes before the markets open so I can see what the futures in SPY are doing. Is that if this is where the close was today, and then 16 hours later, is it going to be a large gap up or a large gap down as a way to start getting? If it's a large gap down, I'm going to look at Tesla and the things that sold off today. I'm going to go to the ones like Dish Network that were horrible, or Clean Energy, or Alcoa and AI, and Tesla, which was down 5. That's if tomorrow the futures are down. Those would be the least surprising failures tomorrow. If tomorrow was a big gap day up, you know I'm going to go look at Disney, which was up 7% today. So this is what I mean by finalizing the scenario prep for each of those symbols that I'm going to target for development. And just lather, rinse, and repeat. Check or hold. All right. So we're going to take a break on that one. And what I'm going to tell the guys, we'll do the nightly podcast start at 9 o'clock because I got to finish the reports because I went longer than I thought I was going to. But I felt like it was necessary for you guys to hear that, and I'm going to make that available to the nightly podcast guys because they need to hear what that sounds like. And if you haven't taken the Foundations course, you probably ought to. Anyway, hopefully you guys found that to be useful, and we will catch you shortly.